Oh, look at that. We're live. See it.
Hey everybody, to the weekly
Well,
roundup, week 7, 2025. Glad to have everybody back.
Just to give everybody a little bit of a benchmark on what the week 7 means, we're counting based on the ISO week number standards for the week year. So we haven't recorded 7 episodes. I think we're on technically 4, Cameron. That's right.
I want to say so,
But
yeah.
we're just cataloging based on the weeks as they progress.
And hopefully every week we're seeing a little bit of iteration on the quality of the live stream. So, have to give a little shout out to our new branding here. We've got the logos going, the different color background, things like that. So, people are listening. If they see this maybe after the fact, if you've got any thoughts or ideas on any of that, let us know.
yeah, good work, Cameron.
Thanks.
It's incremental improvements, right?
Exactly.
Let's hop into it.
Yeah.
All right. Title of the episode: The penny peg has been broken. Little alarmist there, but if you all caught the headlines over the past week, we got an announcement from the new administration. The U.S. Mint is going to stop producing the penny. The end of an era. Hundreds of years of history done. We'll talk to that at the back end of the episode after we get into the key charts. But what that effectively amounts to, and my perspective and framework, is the loss of a decimal point on your currency. So the 100th spot of the U.S. dollar currency has been conceded. So it's a permanent goodbye. I don't think
Yeah, it's not
we'll
coming
ever
back.
see it back.
It's not coming back.
All right, so we'll get into that later. There's a deep rabbit hole to go down. But first, I think let's go into the key charts. The only ones that I'll treat as core that I want to make sure we cover every single week are really the dollar and duration, so the long end of the Treasury yield curve. So the first one to go off of, this will be the relatively short one this week, but the dollar continues to ease off of that massive run-up we saw from August, September of 2024 all the way into the end of January. Across the mid-section of the long-term uptrend channel that the dollar has been in since the post-2008 global financial crisis aftermath. So for the time being, it looks like that pressure with the dollar going on a heater, if you will, continues to let off some of that pressure. So it's a continued story to watch. But for now, we're posting another week for week 7 of 2025 of what looks like dollar coming back in, losing relative value against the other key developed market currencies that go into the DXY index. So those are the euro, the British pound, and the Jap yen. We'll talk a little bit more in a few slides on the euro and the pound specifically. So on to the next one is what's going on in duration. So we saw, we've got this downward wedge that duration has been in, and we've been setting lower highs, lower lows, dating back to the FOMC meeting back on September 18th, where we got the first rate cuts. That was really a key pivot point if you look back on the chart for the last 2, 3, longer term of an intermediate high on the duration rally. Once we started cutting, that's when the long bonds, long end of the yield curve, started to sell off. And you see these pivot points have really lined up since, with the lower high, like we've got 2 lower highs and 2 lower lows since that FOMC introduction of rate cuts into the short term or into the short-term policy rates. We've seen those transitions line up with the key data points, key data prints from Washington, D.C. So the non-farm payrolls reports is where two of them lined up on the last two highs, and then we've seen CPI prints so far, specifically to the December CPI number that was printed to the market on Jan 15th, on the same day as an FOMC meeting, mind you. So there's some muddying of the water, if you will, on cause and effect. But you've really seen a continuation here of the that lower high really locking in on February 6th with that that January NFP print coming in. And so what we're looking at here with duration, my opinion, looking at the technicals, looking at this chart as a fixed income portfolio manager, this could go one of two ways. Coming out of this this downward that wedge where you see the bars getting closer and closer. They're coming in as the market is going to come to the conclusion and the realized effect of where price needs to be on the long end. Which way do yields need to break? Once it happens, it's probably a big move one way or the other. Now you're looking on the upside if the long end rallies, so rates come in, you could be looking at growth expectations coming down or inflation expectations coming down. That would drive bond prices up. Or on the opposite end, you could look at some factor of those two, the sum of them widening, and then yields widening, bond prices down. Either way here, this could be, a trap door. If you're looking at the long end rallying, bouncing out of this channel and into an up move, how do you get that scenario materializing? It probably looks something like growth expectations in the U.S. economy coming down. I can make a narrative for that, or a case where this could happen. Like think about the tariffs that are going into effect having an impact on the real economy, where consumers pull back on spending, businesses pull back on investment, just because after these tariffs, the cost of making purchases or consumption goes up, or for businesses, the cost of imports to put together new finished goods or new services, those go up as well. Everybody pulls back. That growth coming in actually creates a rally in bonds. That could happen. On the other side, you could see a scenario on the breakdown where yields rise, where we say, oh, well, consumers are just going to do what they're going to do. And you see with the K-shaped economy, right, or that we've been operating in since COVID, there's a whole section of the population that is just flush. They're good. You can see with the demographics, boomers retiring, they've saved some percentage of this population has enough wealth, has enough resources stored up. They're hitting that retirement age, those key years, 65, 70, 75, where it's kind of like use it or lose it. It's now or never. Take that trip, live it up, YOLO. And so they're just going to go out and spend regardless. So both of these things could happen, and they may spend into rising prices, and that's been kind of confirmed by everything we've seen post-COVID. You still see strength in consumption even under rising prices. So the pullback mechanism, that higher prices should deliver restraint on consumption, like there should be belt tightening, all of that, and you get a classical 1980 to 2020 type of rally in bonds into that recessionary dynamic. May not necessarily be facing a context, just given everything we see with population, K-shaped economy, all of that. So this could go either way, in my opinion. So from a bond trader's perspective, you kind of have to prepare for both outcomes. Now, that red line where you connect the two, the previous lows. So the good news is, if this is a rally from here, and and we don't retest that line, then you've got two higher lows. That's a pretty soft upward slope for higher lows, so it's kind of indicative that there's not a lot of strength behind the bid for the bond market, as kind of makes sense. This is an asset class that is getting financially repressed. You're losing purchasing power, storing your wealth, and maybe not all credits, but treasuries definitely have lost a significant share of purchasing power in the last 3 to 4 years. But if we rally from here, okay, you set a higher low on the chart, we can move out of this downward channel and break to the upside. Now, on the other end of the spectrum, if you break below that red line, and it roughly prices out, if you take the dollar price of where that line is, it's roughly $47 and one tick. That equates to a yield on the 30-year of just north of 5%, so 5.05%, something about there. And these numbers aren't like hard and fast. They're just, you have a rough indication of where those levels may be, where the market is going to react significantly to it. So if we break in a sell-off and we break the red line to the downside, then you get the scenario where the long end bear steepens, and it's not a good picture for everything, cross-asset dynamics, just my opinion. So right now, you don't know which way it's going to go. Looks like we're going to know by end of quarter, but I think which way this goes has huge repercussions for how the rest of the year progresses. So we're really in this window. You can see this little triangle forming between the two black lines on the wedge and the red line. See that triangle in there? We're closing in where we're going to have clarity one way or the other which way we break here. So we should know soon. 6 weeks left in the quarter. This should be an interesting close to Q1 we have to look forward to. Any questions on that?
Matt,
yeah, go ahead.
Matt, who's betting on the long bond right now, and why?
Everybody. We all this is the capacity to store up purchasing power and U.S. dollar denominated IOUs, considered with maybe not risk-free, but the minimal counterparty risk you can have with your lending to the U.S. Treasury. So the answer is all right, who has the capacity to buy the long end debt? A lot of it's going to be players like insurance companies, for example. Like if you've got life insurance policies and you've underwritten to a 22-year-old or maybe this is too young, like a 28-year-old, let's say, who just bought a house, got married, had their first kid, they're going to buy their life insurance policy. That's when you hedge those outcomes and you go into the 30-year market. That's kind of your classic customer of who's buying 30-year debt. It's pensions as well. Say you've got, these don't exist so much anymore, but a defined benefit plan, and part of your employer agreement is, I'm going to sign up if you come work for me. Obviously, I pay your paycheck every week, 2 weeks, whatever, get your salary, your wages, all of that. But then part of that, if you have a defined benefit plan, is you accrue a pension benefit that materializes, under the retirement. Like, hey, you retire at 65, you're going to get highest salary plus X, just based on some return formula. Okay, to hedge that risk out on the back end, you have to invest in you have a lot of actuarial math behind this, but you have to immunize that liability that you're on the hook for to pay that retiree's benefits. Like, say it's that same 28-year-old new parent with a child and a house, a mortgage they just signed up for. They want they buy life insurance, say they have the pension from their employer. The employer's pension plan will buy. You can buy any asset. Like you go through an investment plan mix. You talk to plan consultants, all that. But a lot of what they'll do is that client will tend to buy longer term debt because they know you're like, all right, I see the cash flows, the coupon, and then the principal coming in at the end of the life of something 30 years in the future. It's got to be something very far into the future horizon. So it makes sense, you're 30-year-old, you put a 30-year bond on it, they're going to be about 60, call retirement age. Now for like investment projects, CapEx, usually there's not 30-year balance sheet capacity for like like any type of real development. Like most projects, well, if you thought about like building a cathedral, right, in the Middle Ages, those things took centuries, generations to put together. So if we had projects that were longer lived in scope, you could technically, if you had faith in the money to be there.
Yes, you got to maintain
power.
those dikes in the Netherlands.
Yeah, well, yeah, if it was something extremely long lived, you may do it. But if it's something shorter term, like just building a bridge, it may take 2, 3, 5 years or something to construct. You're not buying 30-year bonds to do that. So that's your buyer here. That's your market. That's also why on supply, this gets into the next section. If the Treasury is running deficits and needs to increase supply, it's hard to grow capacity just organically the further you go out on the maturity curve. If you just want to go splash the market with more 30-year bonds, you don't have, like, your demand for that is dependent on the actual firms, participants, and the longevity of their time horizon, like in your real economy. And to make a new 30-year-old who needs to buy life insurance, for that example, who's going to buy that long-dated policy, which creates demand for, say, 30-year issuance, you can't just make those overnight. It takes 30 years to, build that, to form that household. You got to have a child, send them to school, send them to grad school, or send them to undergrad, get them placed in the workforce. All of that takes years and is high cost to put together. So the answer is it's very hard to organically construct demand for the long term. Like, you do that, that's like serious work involved in building your economy up that way, which is the real way to productive economic growth. Versus short-term demand for bills issuance, and this is where we get into this week's one piece of news items to discuss. To drop a new bill into money markets, well, this is debt that's the lowest risk, right? It's short-term issuance. You know what you're going to get on the short term. Most firms, entities, people in general can plan their lives and finances 4 weeks out, 6 weeks out, 8 weeks out, etc. So that's why you see a lot of factors involved, but it essentially boils down to that: the shorter your time horizon, more certainty you can have, and the more willing you are to extend credit on a very short-term basis. So if you need more capacity, you have to work. First you want to probably fill up all your capacity at the long end. And the answer to that is, like, right now, we're probably saturated on long end demand at current prices. If you want to plop more onto those sections of the yield curve, you're going to have to pay up. Like, you're going to, as an issuer, you're going to have to pay higher rates. And that's, now you're getting into the knife fight of your borrower here, the U.S. Treasury, wants to keep its interest costs down. Like, interest expense just became, I want to say, like the top spending item over the prior quarter from a category standpoint. So if you want to go blow that out and increase your interest costs, all right, splash out there. But if you just need short-term financing, I just want to get my house in order. Let's give it a shot, as we're doing with all this stuff, the Doge efforts, debt ceiling battle that's coming up in April, all of that. We're going to work on getting our house in order, and that's underway. But for now, what you do when you need to tap more, you need more credit capacity to keep running these deficits or financing these deficits. What do? Exactly what this headline is we're showing right here, and we saw this week. This week, the Treasury announced it's going to transition it was called the 42-day or 6-week cash management bill, which is kind of like viewed as an ad hoc bond or debt market issuance. It's like, hey, this isn't permanent, whatever. This isn't. I don't plan on this week to week. Well, they've been doing this cash management bill, which is supposed to be a temporary measure for. I don't know when they started doing it. Like when it was like 2022, but they've been doing it. They've been making this regularly. And so this week they made the announcement. They're like, we're going to make this what's called a benchmark issuance, which is the benchmark issues are the regularly scheduled auctions. So your primary dealer should now plan on these taking place every week alongside the 4-week bill, 8-week bill, 13-week, 17-week, 26. Add the 6-week to that lineup. All of these things you got to support. And basically the reason you do it is because, all right, we need to borrow X. X keeps going up. If you want to keep funding yourselves through those same 5 issuances, like different tenors I mentioned, what you'll have to do is you're going to have to grow each auction size. Right? Like if we need to borrow 10% more each one of those, we got to find a way to spread it around, but on the net, like you're going to grow each auction, and unless you get more buyers in, that means yields are going to have to go up, which we don't want anymore. Fed's saying with the rate cuts, everybody's like, all right, we're done. Rates have gone up high enough for this cycle. Granted, there is some talk you're starting to hear now about, hey, is there going to be hikes again as opposed to cuts? That's not consensus. The consensus is still there are more cuts coming, but it's priced right now that the next one will be in July. And this is similar to what you see in other cycles where we do the first round of cuts, we assess the damage or we assess the impact. That period can go multiple weeks, few quarters even, and then you survey what's going on, and then usually it leads to the final wave of easing, which is cuts, etc. Market right now, the consensus is those are coming. Cuts in July, cuts through the end of 2025, but they're not going to be in half one. Like half one, we're in that pause period. So right now, to keep rates from going up and the bills issuance, you don't want to. Treasury, the Bessent administration, made this announcement this week. Now, this was in the works. I'll get into some slides in a second. But we're going to now make that 6-week CMB just a planned issuance. Just fund it now, going concern. You're going to have to keep rolling over those 6 weeks into the 6 weeks obligation. So treat this now as a thing that needs to be as a debt issuance that needs to be financed through the dollar system.
So Matt, this is like the home handyman's. There's an adage. There's nothing more permanent than a temporary fix. You're saying this thing is the intent is that we'll just plug a gap here, but this is just going to stay.
No, you can't assume this is permanent. It may. I mean, we'll see how this develops 3 years from now, 5 years from now, but there are instances where the Treasury doesn't need an auction anymore. Like, believe it or not, like there are stretches in the 2000s where, hey, we didn't issue the 52-week bill. Why not? Oh, because we didn't need to. We were running surpluses. The fiscal condition was getting better. Same thing, like the 2-year. You go through periods where it's like, hey, we don't need to roll that over. Like that 2-year maturity from 2002 that's coming due. It's like, well, we don't need to just roll it over and reissue it. We're like, we'll pay that one down. That credit card's paid off, and then you don't get the auction yields on those. Now you can still have a synthetic, like you can measure. There's always Treasury debt maturing, and so you can see off the runs, like the old Treasuries, like a 5-year, 3 years have passed. It's now a 2-year, but it's kind of stale. The market activity, it's mostly found the balance sheets that needs to find it, but there may be someone out there who needs specifically a 2-year Treasury yield, and maybe there's no auction going on. You can go bid it. The primary dealers will inventory some, so you'll be able to still kind of price out a curve. But no, don't assume that the future is locked in with any certainty, because it's not. It never is. And if I ever give that impression in my statements, like nothing's ever permanent. These are everybody involved here. They're not non-playing characters. They're not NPCs. These are smart people. They're read and react. There's geopolitical context involved, as we'll get in with the Ukraine peace talks. But like these things can change, just subject to decisions and how things break. Like we don't know how the charts will break. No one does. But ultimately, like that's just how the present turns in, or the future turns into the present. All right, so we got the 6-week T-bill issuance, but this is, as said, this is part of a broader trend. We saw this with the 4-month or the 17-week. They added that as a regular benchmark issue. I want to say 2023. They're like, okay, yeah, we got to open up a new credit card. We're going to call it the 4-week. We just did the same thing with the 6-week. It's basically like taking out a new credit card. Your next one, see, the recommendation was actually made in a TBAC report, April 30th, 2024. It's a typo there, 224. I just caught, but that's my fault. 2024. So this has been a recommendation. If you go into the office buildings around the White House, the Treasury office building, they were planning to do this for almost a year now. Bessent is in. We have a new Treasury Secretary. Now, where he wants to go in the long term, it's going to be a complete 180 from the Yellen administration and probably a lot of Treasury policy over the last 2 decades. But for right now, like, you can't just turn the car around 180. Like, the fiscal condition you inherit is what you inherit. So right now, remember, we've heard this headlines, or the headlines geared around the idea that the Bessent administration, they want to get the debt shifted out so that we can finance the federal government, not so reliant on bills in the front end and just ramping that thing up with these high rates. They want to term some of the debt out, start using the belly of the curve, maybe even some longer term maturities. So, under the caveat that yields need to cooperate. You saw that statement. Didn't put a news article in it, but
10-year, right?
Yeah, there was a statement from both Trump and Bessent. I think it was last Wednesday that they said we're going to follow the 10-year. Not so much. They'll follow obviously the short rates and Fed funds and monetary policy, how they implement on the front end, but they're going to listen a lot to the longer term. They specifically said 10-year. So they do want to, like, just don't assume that this means Bessent is a liar. He's, full of crap, doesn't know what he's doing. No, that's not what's going on here. He inherited a situation. You have to keep the thing running. You have to keep the machine in motion. But over the long term, and this is going to be like by the end of the year, this is where you should start to see if we can get more of that funding shifted out to the beyond the belly of the curve. Now, what does it look like? Like forward-looking signals, right? You're always trying to see around the curve, right? What's around the corner? How do I know which way this is breaking? The next step from that TBAC report published in 2024, and they were actually, the title of the report was Potential 6-Week Benchmark, right? Well, now we have it. The next step, if they need to add a new credit card, they considered the 5-month bill. So then we'd have a 1-month, a 6-week, a 1-month, a 6-week, a 2-month, a 3-month, a 4-month, and a 6-month. They're like, well, just add a 5-month credit card. That's an option, right? They could put a 5-month. The other thing you'd really be watching for would be for the Treasury to launch a 1-year floater, so a floating rate note tied to SOFR. That would be the kind of cousin of the 2-year floating rate note. So it would be, this would be kind of weird, but it would essentially be a 1-year SOFR-linked bill is how it would end. It'd be just watch for that, and if you see it, that's what you would get. These instruments already exist, like SOFR futures are effectively this. It just means that it would be a debt instrument, and the funds go into the Treasury itself. So if you're a headline watcher, trying to see it around the corner, which way the situation's going, if the deficit situation, the debt situation isn't getting improved, and when I say it, I mean improved. You're not looking for, the bar isn't solve it, right, with Doge and everything going on. It's like the example I've heard of the pool shark, right? When we get someone more and more behind, and someone at the end of a night and a grimy pool lounge is, let's say hundreds of dollars in debt, and they say no, all or nothing, like double or nothing. Your pool shark will tell you, no, you got to get healthy the same way you got sick. Like slow, you're going to take one off me one at a time. I'm not going to give you double or nothing. Think about that with Doge. I don't know if that was a good analogy, if it sunk in, but like Doge and what's going on, and then the debt ceiling debate that's going to come up in April. All of these things going on. You can put the Ukraine peace talks, all of that, and as a part of this, but the standard isn't solving the fiscal deficit situation overnight. It is not going to be solved overnight. This is not going to be easy. The point is, like, you got to get healthy the same way you got sick, right? So the sign you're looking for, if we keep getting more and more sick, is actually one of the things is if we have to launch this 1-year floating rate note. And that'll come, it'll be 12 months away, 24 months away, etc. But if the Trump plan isn't working, that would be like a safety valve, or escape hatch, if you will, for what we're trying to accomplish here with Doge improving the fiscal situation. All right, some honorable mention charts. I won't talk about these every week, but these will be important to some of the narratives we'll address over the rest of the show. So one chart here, this is the Euro Stoxx 50. This is the EU continent top 50 public equities in an index. So it's kind of like the Dow. It's a price return index. I always got the opinion, I'm going to add some color here, maybe spice it up. Europeans think of themselves as classy, right? You got LVMH, Ferraris, we're high end. But I've always found it, kind of, I don't know what the right word is, off-putting, or doesn't really fit to title your benchmark index with 2 X's, like this is a 90s either hip-hop singer or, pornography type of product. But 2 X's, come on, Europe, you're better than that. But anyway, here's the real takeaway. Hopefully I have your attention. The Euro Stoxx 50 just broke out of its all-time high set in the late 90s. I know you can't see it on the chart here, but Euro Stoxx 50 has now broken out, and equities are rallying hard. So if you see that line, just pumping since the November election, European equities are getting bid hard. I'll tell you my interpretation of why as we get into the rest of the topics. Next honorable mention, FTSE 100, the United Kingdom's large cap stock index. This one's not an all-time high. This thing's been trending up, but you see on that trend line, no matter how you draw it, it's also punched through and broken trend. So see that like out of Europe, EU and UK, 2 separate markets here post-Brexit, equities are getting bid on the continent and whatever you call UK, the island. I don't know, Dave. I'll defer to you of most recent British immigration. But anyway, equities are pumping, and then on the currency side, this is part of your tell. This is the British pound since 1971 versus the U.S. dollar, and this is for a developed market currency. This is what debasement, or this is what the relative value debasement looks like as a poster child. So, see the pound putting in a low back in 2022. Remember with the squeeze as the Fed started hiking rates, we got close to the pound breaking the buck versus the U.S. dollar. First time in the history post-revolution that would have happened, that the rebellious colonies and everything they built up have ever achieved 1-to-1 parity with the pound. It's going to be a massive moment when that happens. I consider that a win, not if, but as I said, like the future isn't for certain, but if there are things that are more probable than others, I do see this trend. If we're watching everything that's happening, one of the things you can probably look forward to is the pound breaking the buck. So that's something we'll continue to watch closely. Won't talk about it every week, but given what's going on in FX markets and the gold run in London, we'll touch on that briefly. The pound chart is going to be something interesting to watch over the remainder of 2025, in my opinion. And then the euro as well. Euro's weak, but not as weak as the pound. But we have, obviously, the euro has been marked below the buck. It's already broken the buck. That's old news. But at some point, like you'd expect to continue to see some of this action going on in Ukraine, peace talks underway, some of that working through the euro as well. All right, so on to the headlines we want to cover. So you'll see these stories about tariffs, the gold price run, whatever, like planes being filled with gold bars and shipped. Maybe even on your flight from New York to London, if you're lucky, there's a 40-ounce gold bar coming over from the LB. No. The physical gold is going from London to New York.
London to New York.
What's actually going on here? If you're financial press, we're doing a good job informing the investing public. What's going on is gold is being drained from the UK. Like you go in the old world, the saying was the golden rule, right? There's obviously the Christian version and the Western tradition. That's not the one we're talking about. We're talking about he who has the gold makes the rules, right? Well, gold draining from your vaults is never a good thing. This is like you can see what's going on in the dollar, the weakness, but as the dollar has broken and the pound has started to get a little bit of a bid, euro's getting bid, etc. Gold is leaving vaults in London, coming to the U.S. Now to get the gold, what do you got to do? You have to buy it in pounds in London, exchange it for gold, take physical delivery, ship it over to New York, blah blah blah. There may be a tariff involved. Whoop-de-doo, 10%. Like that's a catalyst, but it's not the main story here. The real story going on is the base money of gold is moving out of the city of London and making its way into, right now, the beneficiary is U.S. capital markets. Like obviously, you've seen central bank buying from Asian economies as well, but the action, if you look at the charts, COMEX inventory, gold and silver on the left, London's LBMA gold and silver inventories on the right. The traversal is one way, and that's the key takeaway that you really need to understand what's going on here. If you think, okay, we'll go into the situation in Ukraine here, but for your financial system, the gold leaving your borders, leaving your financial system, you're getting called. It's not a good thing. All right. The other thing too, like a couple of weeks ago, Cameron and I showed on a slide the results of the Goldman Sachs Marquee Quick Poll. It's a survey of money managers. I had the response of it's like almost 1,000 professional money managers across all asset classes, and they asked for basically your sentiment on a lot of different trades. And for gold, it lined up like everybody is leaning onto one side of the boat and getting bullish on that trade. From my perspective, that comes in the late stages of a wave. When I say a wave here, talk about like Dow theory, all of that. But what it really means is like markets move and they trend, right? And at the early part of a trend, you're coming out of, let's say, a bottom on a chart. Like things look bearish. The only ones who are really bullish about the asset are the most strongly convicted. You see this across, like, it really maps to any asset class, like Bitcoin, stocks, whatever. Like, if you're going to buy at a low and come off like the first stage of a bull market, like by definition, it's the most strongly convicted who are willing to come in and buy at a low price. Most people don't buy low and sell high. It's actually the opposite. All right. So at the beginning of a bull wave, of a run-up, sentiment is poor, nobody likes the asset, etc. And by the end of it, by the final run-up, everybody gets bullish. They see the price run. They extrapolate it and expect it to continue forever. And you can get really aggressive final moves, or it just depends. It could, just continue orderly, etc. But that survey I saw from Goldman Sachs, and just given everything we're seeing, like, we're at that stage of the cycle where now the physical is moving. It's finding a new home. There's gold supply is not fixed, but it grows at a small percentage per year. And so in the short term, it's the same amount of gold in the world. It just depends who has it, who has custody, who has beneficial ownership. And right now that ownership is moving from London to New York. Now on the trading side of that, the professional money managers have started to lean universally bullish, which is kind of like what you'd expect for the last push of a run, of a bull wave. So now sentiment is like lining up towards the extremes, and that's where you see the last stage. So, eventually London runs out of gold. But
Matt, you're seeing it. I might have mentioned this last week, but you're seeing it. I mean, retail is piling into.
Oh yeah, they're buying at Costco now.
Trade. Yeah, no, I went to Costco and you scan in now, right? So the person at the door doesn't actually do anything anymore. They stand by the scanner. So the person at the door was holding up a silver bar that you could buy. So it's not gold, but they're still selling ounces of silver at the door at Costco. So I don't know. That's where we're at right now.
So that's what's going on. These kind of line up with the credit cycle as well. Like, you see, like, a lot of gold. Like, you got to have collateral behind your credit system, behind your fiat currency. At the end of the day, what are you backed by? Well, mark up the value of the gold. So now you've got more gold inventories inside the United States and a higher price. That actually, the collateral is the product of those two things. You can keep building your credit creation off of that. Now, if you're London, you're in a pickle. You've got less golden inventories, and your prices aren't marking up high enough. So you're underweighted on price relative to other countries or other competing developed markets, and you have lower quantity now, which means the collateral layer of your monetary system. Now, we don't have a gold standard or anything like that in our banking system, but it is marked as collateral, and there's leverage created on top of it. The nominal product of those two now is shrinking, which creates a problem for your credit, your currency. All right. I want to talk about Ukraine. All of these things kind of weave together, right? So Wednesday, we had a big announcement. Trump had a phone call in the morning with President Putin, and is basically the tables are set. You've got the U.S. now that we've changed policy from the Biden track to the Trump track. The shift is the new U.S. administration wants to sit at the table and hammer out a negotiated peace settlement. Putin is there. He wants to come in and negotiate a peace settlement. And also Ukraine is there. Zelensky wants a negotiated peace settlement. You read it in the quotes. I think we're on the way to getting peace. This is a President Trump quote. I think President Putin wants peace, and Zelensky wants peace, and I want peace. I just want to see people stop getting killed. I think we can all agree. Everybody in the world should agree with. I want to see people stop getting killed. Like terrible outcomes. If we can end the war, let's save unnecessary bloodshed, fighting, warfare, etc. It's the most destructive thing human beings can engage in. All right, what's the holdup? Version 2. This is from France 24. The next task is to ensure that there is no dictated peace, says German Chancellor Olaf Scholz in an interview with Politico. So you see, the only remaining stakeholder not at the negotiation table who wants to keep this fight going is the EU. Full stop. That's what's going on. So what you're seeing here, U.S. is in, Ukraine is in, Russia are in. It's going to happen. Now the question is, what terms are the EU and UK going to get? And now you're showing up to the table at the weekend, and you're going to be forced to draw the short straw, whatever that looks like. Now, what does that mean? It's economic terms, right? Go back to, like, thinking analogies here. The extremes inform the means. Go back to the last time, the 20th century's realignment of geopolitical order. First marking the market event was World War I, and it was a brutal catastrophe, and then absolutely destructive way, like horrible. We get to the Treaty of Versailles. It's really an intra-European conflict. You know, as opposed to World War II was global. World War I, though, it's really France and UK sitting down at the table with Germany, like the old Austro-Hungarian empires, all of that, Ottomans, whatever. The order gets shuffled, but like UK and Germany, London and Paris go into the Versailles Palace to negotiate the peace settlement from the position of strength, mainly because they had the US behind them as just the leveler. And so they come in and they put the screws on Germany, right? Like, Germany takes it hard. All right. We don't know exactly how this version of the peace is going to go, but now we're setting, and the seats have been flipped. London and Paris are now going to be coming into this situation at the Munich talks tomorrow, is where these sideline discussions are happening with Hegseth, other ministers. But, like, this is underway. Munich is the precursor, the talks before the real talks. There's going to be a peace settlement because U.S. and Russia don't want to keep fighting. Ukraine wants to figure something out too because they're getting bled dry and they're running up a massive debt. And then also the financing, the checkbook is closed. So if you think about all these financial gimmicks, hey, we're going to take Russian reserves, we're going to lever those up, U.S. Treasury is going to lend to Ukraine using those foreign reserves, or recycle them through the EU, recycle them through London, whatever. That's done. This administration is not doing that anymore. That funding route is over. So you're either going to have to see if the UK or EU want to continue this, they're going to have to finance it themselves, fund it out of their own GDP, increase their own deficit spending, build up their own defense contracting sector, military industrial base, all of that stuff, if they want to see this continue, which those things are going to take time. So they may do that. Like, that still may be the plan. The same way World War I didn't actually solve anything. Treaty of Versailles didn't solve anything. It was a temporary peace. It was a terribly negotiated peace. The only thing it accomplished was to set up an even bigger conflagration and disaster with also the progression of technology. You know, you start in World War I with industrial warfare at the ground level, like ground game. You have machine guns, tanks, chemical warfare, etc. By World War II, you had aircraft carriers, airplanes, heavier bombing,
strategic bombers,
encryption, cryptography, communications. And so just the loss of life, capital destruction, was that much worse. So my point here, if EU wants to screw this up, and UK, if London and Paris want to keep, like, if they want to get this wrong as badly as they did at the Treaty of Versailles, they could technically figure out a way to do it again. Now, they've been enclosed. The land powers, Russia and the U.S., are in a better position, I think, to show up with a more important seat at the table in these discussions. But if the EU really wants to put its weight behind this for 10, 15 years and build up and then make something bigger happen, you know, when we come back, I don't know if we'll be still doing this in 15, 20 years, but they could. So I think that's the future you have to be very careful about. But anyway, this statement here that they don't even want to come to the table, I think the media approach you've been given for 3-4 years, telling you, hey, Putin's the bad guy, and he's not a good person by any means, but when it's time to make peace and hold the peace talks, there's only one group who doesn't want to show up and wants to keep proliferating the war. And in my opinion, that's telling you everything you need to know. All right. This is some results from the ceasefire poll today. Same thing on Goldman. I talked about the gold poll, the marquee click poll. There's some interesting things how money managers view this, because this negotiated peace is going to work through asset prices. It works through the currencies, the mark-to-markets, works through equities in each country, and it works through IOUs, your fixed income credit rates. So this has huge implications, what this settlement looks like. But the odds, this came out this morning as these kind of the story is unfolding in real time. But the question is, what odds do you assign to a ceasefire, a Ukrainian ceasefire, in 2025? And this thing just opened up. It's 119 votes now. I'll tweet out the final once it gets done. It's going to close. It's only open for 1 day. And these are professional money managers who are clients of said firm. But the odds are now, most people see the odds at more than 75, so 40%, and then 37 or 50 to 75. So it's better than coin flip that this piece is going to happen, is what the money managers view this as. Dave, you had a question?
No, I was saying, yeah, you had those two up. It's 77%.
Yeah, and this is what we're pricing into the bond market, to FX, to stocks, everything. This is the needle mover that everything is turning on. All right, which ceasefire scenario is more likely? All right, option A, gradual decrease in hostilities leading to a de facto end of war, or B, a rapid and credible de jure resolution. What is the difference between these two? A is kind of organic. We're like, yeah, we just stopped fighting. We're going to put down our arms, whatever. It's like everybody agrees to end it, but there's no legal force behind it. The nation states aren't behind it. The EU Commission's not behind it. Like, it just kind of happens. That's never how this works. Like, when it's time, when the conflict is done, when the marking to market is complete, the only way these things historically ever get finished is when one side agrees to stop fighting. You've defeated the will of your adversaries, and it's enshrined in legal code, or it's enshrined in international agreement. So you still see the money manager saying it's option A instead of B here, the rapid and credible de jure resolution. De jure would be like you have an international law type of agreement, a formal treaty, lines are redrawn, XYZ, everybody has a common understanding, people know their role, shut their mouth, all of that. The market right now, the money managers thinks it's just A, we're going to be just decreasing hostilities, we put our guns away, everybody goes home. That's not a lasting peace. That's more, we see this as a temporary solution. So if you look at markets, as I try to think in the long term, they're weighing this as almost 2-to-1 heavier, that this is something temporary, and basically we're saying, like, we haven't written the final chapter of this realignment, which kind of makes sense. Like, you'll know it when you see it, because one side is going to wrestle arm wrestle the other one to the ground is the only way this is going to go, my opinion. All right. So maybe thinking on that, I should my vote. You can see my vote here in yellow. I do think this is going to be like there will be a legal agreement between U.S., Russia, etc. Like there will be some sort of treaty signed. Now, does it get recognized through like legacy bodies like the UN? Does the EU recognize it? Etc. That's TBD. We don't know. So there's a lot of uncertainty here. We'll see. But I think like this does have to end with one side getting wrestled down fully. Maybe I should flip it over to 61, but I think there's some vagueness in that answer because I do think there is going to be a de jure resolution here this year between Ukraine, Russia, United States at a minimum. But is it the permanent solution? I think, yeah, it's probably more like what is behind the general look and feel of what option A recommends because the EU, London and Paris may not come along.
I think just to add to that one, it's the time horizon piece that they haven't bounded, right? So it's tough to decide in that poll.
We got a whole year. These talks,
Yeah.
This is not going to go on forever because the fiscal situation is going to demand it. I think this year we will see clarity. And if you go long enough, like in our lifetimes, like we can't wage a major war for 40 years. Like we'll waste all of our resources. The capital stock will be destroyed. Like we'll be eating ramen noodles both. And like sticks and stones. Like that, it won't go on forever.
Both. You can have in eastern Ukraine. You had effectively secessionists. You had a war brewing since the Crimea takeover in 2014. You didn't have a full cessation of violence there, but from outside looking in, it was a de facto cease of major hostilities. Right, the Russians came in and took Crimea. So
this is where, depending on where you're getting your information and follow the situation, you could be extremely ill-informed. And I think generally the Western perspective on this part of the world, we really aren't well informed. I'll leave it at that. But this thing started. This phase of the escalation actually started in 2014, post 2012 election, all of that, with the policy to effectively January 6th hostile takeover, color revolution, the Ukraine government, and then we've rolled the tape from there. I'll leave it at that because we'll eat up all of our remaining time. But there was this thing has been building towards the crescendo, or the climax. And maybe this isn't even the end of Act 1. We don't know. Like, we're not going to know until history reveals itself.
It's the classic politics thing, right? How far back do you want to go to figure out?
Oh, that too,
right? So,
that too, yeah. We can start with the discovery of the Rus people. If you listen to like hardcore history podcasts, there's a good one I'm listening to right now that goes back to when the West actually first encountered the Rus as a civilization. It was something like 800, 900 AD, Byzantine Constantinople. But yeah, you can go that far back if you really want to, but we don't need to do that. Let's just stick right here.
That's a damn, Carlin.
All right. The probability, so this is just how the money management community has reassessed their probabilities since Jan 1. And this isn't even since the election when it should have become apparent, like, yeah, there's going to be a total change in policy on Ukraine. That one should have been obvious, but the money manager community, they are self-admitting here, it locked in. They updated their priors significantly, like 91% either increased their probabilities of the ceasefire by more than 20 or between 0 and 20. And then let's see, and then this is the asset class. Which asset class do you expect to move the most once a ceasefire is reached? Now, this is a little bit weird because you're thinking in terms of magnitude, right? And I put down EUFX. generally, if you're looking at foreign currencies, the volatility and the movements are much less than what you're seeing in equity markets, commodities, and then lower level than that would be bonds. FX markets are not supposed to see massive volatility and movement, but just based on scale and what's and size and scope and impact on a market, I think, my opinion, it's going to hit FX the hardest. But then from volatility, magnitude, pricing on a much smaller asset base, yeah, nat gas makes sense, just given the pipeline situation with energy as part of the core conflict of this whole, I guess, engagement, whatever we want to call it. Unfortunate situation. But yeah, I put EUFX because dollar to euro, you're repricing every asset, and then you're looking at literally the pricing of commodity, of deposits between the banking system of each, and then everything works downstream. So just because of the wording of the question, which asset to move the most, I think it's going to disrupt FX markets most heavily first, and then everything builds on a base layer off of that. Now, the thing about EU equities with 28%, I agree with that as well. So what I see happening, so this is a massive mark-to-market loss here. The reason EU representatives in Paris don't want to show up to the table right now is because, to go back to the pool shark analogy, they're the customer who's in the hole, or they're the what's it called, the mark who's in the hole $1,000 at the end of the night and needs to figure out a way, is going to try to figure their way out of this any way they can to get back to remotely close to even. So they've got the most to lose. They've already got, and they don't want to lock in their loss, is effectively what's happening. But that goes to financial markets, but also territorially, even though it's not actually their territory. Well, you can say sphere of influence, right? They're going to have a section peeled off from them of the economics and their sovereignty, seigniorage over an area, not just population, but mainly, like, most important, mineral rights,
minerals, yep,
commodities, cheap labor, all of that. So what do you expect to see? So your currency is going to get mark to market. Your gold, your money stock is leaving. What do people flock to when your currency has to take a hit? You flee to the higher, like, harder assets, right? And so the liquid store of value asset, and everybody thinks like Bitcoin, right? And if you see it, you're there. It's still so early in Bitcoin. Like, take a pause here, everybody who is on the Bitcoin tribe, is on to that scent. They see it. Most people don't still. So within an economy, what happens to your equity market when you're going to take a debasement of your currency? Like, you're going to get marked down on a relative value sense. On top of that, there's no growth in Europe either. Like, it's an aging population, demographics are terrible, debt situation is terrible, growth is terrible. They don't have any tech companies. They actively dislike the tech companies. They do everything they can to, like, get them out. Except for they have ASML, maybe a couple other ones, but GDPR, all these regulation, everything. Like, there's some good in that, like privacy, all of that. So it's not all negative, but overwhelmingly, I think the economic situation from a growth perspective in Europe, demographics are key, and the specific composition of their main companies, which tend to be industrials, legacy industrials. It's not looking good. But anyway, when you have to take a currency debasement, what are people going to do? They're going to buy that scarce asset. And that's where you see it's like, oh, the natural response, like, buy equities, like, get into something better, because your inflation, your debasement, everything, you're going to have to take a hit. And that's what you see with their stock markets hitting all-time highs in their local currency terms. if you look at the composition of the companies in the Euro Stocks 50, there's no growth tech stories there, really. There's some financials. You can say, like, okay, maybe the European financials do well, whatever. But it's legacy companies, chemicals, industrials, BMW, Mercedes-Benz, not really innovative. Like, there's no growth there. They don't have something like the Mag 7s, where if you're in the U.S. and you see the stock market run up, like, you're seeing price driven up by a growth narrative. You're like, AI is going to be the thing. We're going to bid AI. Every Mag 7 is an AI story, right? It's not that in EU. You're buying BMW, Ford, or not Ford, Mercedes-Benz, legacy companies, and paying higher prices there. It's the stock market itself that's getting bid up. So you take this holistic patchwork together, that's what's going on, and hopefully my long spiel here gives you a better perspective of what's going on and what these big picture geopolitical kind of talks, context, all of that is taking shape into the core asset classes. All right, let's get into the best story of the week. The penny peg has been broken. So to intro this, kind of we were all kind of hit. The headlines are coming so fast and so furious, it's hard to keep up with everything. Like Dave here in the office yesterday was like, hey, did you hear we did a prisoner swap with Russia? I was like, that one didn't hit my radar, and I didn't focus on that. I need the financial market impacting and trading one teacher for one money transmitter.
Yeah.
Money
Well,
launderer.
it was a Bitcoin exchange guy is
Yeah.
the reason I brought it up.
Doesn't-
But
yeah.
and it was definitely it wasn't the merchant of death
No.
for WNBA player. It was sort of lower tier. It was
This wasn't
a teacher.
Luka Doncic for AD. Didn't make those
It
headlines.
was teacher caught with some weed for a Bitcoin money laundering guy. So a little bit lower tier. And good that we got our guy back. But,
Yeah, just general,
Not-
I don't give advice. There's no financial advice here ever, but just general advice, people. If you're going into Russian Federation territory, do not take marijuana with you. It is not
Seems like a
going to
bad
go
idea.
well for you. That terrible idea. Okay, so the penny peg has been broken. What do I mean by that? One, it's kind of funny, like we're going to get rid of the penny. Yeah, everybody knows they're essentially worthless now. You zoom out, you go to like stories of the post-Civil War or like the settlement of the West, where when last time the penny actually carried any value, right? And I wanted to go back and find like a Western or something like that, and I could, maybe next week. But what I recall is like stories from like the West as people leaving my home state of Missouri, heading out for Oregon, whatever, on the Oregon Trail. You stop at the general store. You fill up your like 2 weeks worth of rations for like a penny, right? And so you actually had some value in your hundredths decimal place, so 2 points to the right of the decimal place, in your currency. We've lost that. So we've sacrificed the 100th spot. Now the 10th spot of the decimal position still has marginal value, but let's be honest, like what do you get for 10 cents or less than $1? We all know, like it's essentially nothing. Maybe there's the 99-cent whatever fast food menu item, but those were going away post-COVID. So the point here, when you stop making the penny, we're going to talk about coinage, seigniorage, all that stuff here. But it used to be, you get the base metal. That was your proof of work. In Bitcoin mining, proof of work. Everybody kind of understands that, or if you don't, go understand it. Make sure you understand it, because it'd be a nice thing for you to fully understand. But the proof of work, before the semiconductor, before the internet, before cryptography, all of that, really was mining metals out of the ground. And everything with the old money standards, the dollar, British pound, all of that, pound sterling, actually stood for, right, a pound of sterling silver, like the pound sterling. Dollar was indexed to gold in its initial like weights and measures definition. So the penny was attached to copper, right? Copper, industrial metal, all of that has major use cases and goods in the economy, right? Wiring, etc. So you have value in the metal itself, and then your monetary authority will stamp it with seigniorage for verifiability, right? So you can take that coin and the emblazonment, the seal, the picture of an old dead guy or your ruler. That's really there for verifiability, and the state then can then mark up something in like coinage premium for attaching that verifiability to the metal, right? Because if you just take scrap metal, like no one can transact in that as money.
The verifiability was for the amount, right?
That too, yeah.
Weight.
Well,
yeah,
weight
and like
content.
the king put his stamp on it and say we certify that this is the weight. Yeah. That's the whole point. Yeah.
So if you think about it, that starts out, if you get into that business from scratch, that's a profitable endeavor, right? I'm going to go buy scrap copper. You could say gold too, whatever, but stick to the penny. Copper. We're going to put it through the stamp. We're going to put our number on it, and then you trade it into the market for literally a penny. And back before, like, price of copper should have been less than that. So it starts out as profitable, right? But then eventually, like the metals content, the debasement, all of like the process of building up credit claims on top of your currency, on top of the base metals, eventually it gets to the point where it costs you more to acquire the base metal than you're able to make on that profit of seigniorage and coinage. That's kind of where we are at the extreme today. Like, we've been through multiple versions with the penny. If you go back and look at the historical cycle, hasn't been 100% copper since the Civil War. Turned it into bronze, 95% copper, 5% tin. Post-Civil War, we changed the mix throughout the 1900s. There was a period post-World War II up until 1982. We switched from bronze, which had a 5% tin component, to 5% zinc, save on costs, weight, whatever. And then post-1982, it just becomes this whatever. It's 95% zinc, thin plate of copper. And so the precious metal content just gets debased itself. But then you actually lose the ability, like, to produce with any metal, whatever you want to do. You can't produce a coin that holds its value at 1 penny profitably. And that's where we're at, and we've been there for a long time with the penny. And so instead of bleeding hundreds of millions of dollars per month, which has lost its value in economics, period, I can't take that penny and do anything with it in an economic transaction of any value with anybody. Like, if you see a penny on the ground now, do you even pick it up?
No.
I had a rule. Hold on. I actually had a rule. I used to do this, Matt, because it was a good reminder that you should never turn away free money. It was a good saving reminder.
Great point.
No, I did. And you can ask my wife, and it was sort of nasty. I stopped doing it when COVID hit. Remember, at the beginning of COVID, we didn't know what it was. Remember when we were all doing Lysol on our groceries? It was like, oh, this thing, you can get it on your groceries. So I stopped picking them up, and then I think I gave up because I saw inflation. But now it might be the trade to get as many pennies as you can now, because they're going to go out of circulation. They're worth more. So
yeah,
maybe start forwarding.
Pennies,
okay, so go look on the ground and just be aware of this. How many pennies you see on the ground that aren't getting picked up? That's your signal.
And just to add a point here for Matt, so I looked this up last night. The 2024 U.S. Mint annual report, penny seigniorage to make 1 penny is negative $2.69, right? For the nickel, it's also negative. It's negative $1.75 to produce a nickel.
Nickel?
Per dollar of penny. Per dollar of nickel.
I was going to say, you can't be that bad.
The only ones that are actually making positive returns, in quotes, over the underlying metals are going to be the larger denominations.
Yep. So that's the story. So what effectively this amounts to, we can get into it. We've let go of the. This is the final stage of letting go of the rope of a decimal point on your one of the orders of magnitude. So we just gave up the 100th point. It's never coming back. Your currency lost it. Now you got to defend the 10th point. I'd argue you've lost the dime, and every extreme less than $1 from an economic perspective, you've probably lost that as well. Not fully, but it's getting close. And so what you're gradually seeing with the debasement of a currency, and this is just a process, direction is one way. Entropy works one way in a unit of account. The water only flows one direction. What we just saw is we gave up one. Now, big picture, what does this mean? Or how do you put your mental model here? So look at an extreme case. Extremes inform the means. There's this article I like that I came across a few years ago called The 50-Year History of the Ibovespa, the Brazilian stock index. And there's something buried in there. You know, it goes into the nitty-gritty about the Brazil companies, et cetera. Well, here we have fertilizer companies, whatever, oil and gas, here's a grocery store. Who cares? The piece I really liked was this one that's talking about inflation, because what happens is you see a melt up in the stock market, as you see with, you know, a lot of episodes with currency debasement. You see the stock market get bid and just go on a run. Doesn't mean your companies are any more valuable. It's not growth. It's not technology. It's not anything to do with real economic growth. It's all currency. So you see this paragraph I snapped to in the call out, the Brazilian experience where they went through a hyperinflation. I think I have a fun slide here about their banknotes coming up. But quote here I like. Annual inflation rates grew from 3-digit figures in the 1980s to 4-digit figures until the mid-1990s. Like, this is a hyperinflationary scenario. Now, difference between inflation and hyperinflation, it's a matter of speed. How fast is the car going? How quickly are you losing control? How volatile is the system getting? All right. As a consequence, zeros had to be continuously removed from the Ibovespa. A total of 12 zeros were slashed from the index from 1983 to 1997. So literally what they're doing is, you see the price quote of the Ibovespa index. It goes lunar. And then to make any economic sense of it, what they did is they're like, whatever, we're just going to shave off a zero from the right, shave off a zero from the right. They did that 12 times in the matter of 14 years. So once per year. That's an extreme case of what these situations look like. Not making the comparison in terms that the U.S. is going through this at the same speed that Brazil was from 1983 to 1997. But it is the same thing. You lost a digit on your currency. That 100th decimal point is gone. It's never coming back. So that's the process to understand of what's going on, the framework to take this from. Dave, this is your quote about Canada eliminating the penny.
Yeah, well, this was 13 years ago. Canada. So you've already made the point that when you take that 100th decimal place off, the inflation's already happened. This is not. It's a lagging indicator. So the Canadians did this in 2012. And they have this guy here. You can go look it up. There's the source there. You know, they had this economic action plan. They had this guy, and it, basically said, "Oh, well, due to inflation, we're going to get rid of this." And don't worry, removal of the 1-cent coins in other countries, such as New Zealand and Australia, did not cause an increase in price inflation. And that's kind of the no-duh headline. If you look at this, well, the inflation had already happened. So what you see is that New Zealand. Everyone suffered through inflation in the 70s, right? The 70s, early 80s. New Zealand and Australia suffered it to a much worse degree. So they got rid of their 1-cent piece, not a penny, but a 1-cent piece in 1990. Australia followed in 92. And you can see that this is both after a big run-up in inflation. So it took a little bit longer for Canada to do it because their inflation didn't happen as quickly. And I don't have the U.S. chart up here, but I'm guessing it's a little less worse for the U.S. So the point is you've already made it, but like this is basically telling you you see the price of eggs is $8. Us getting rid of the penny, and we probably should get rid of the nickel as well. It's just telling you what you already know, that the inflation's already happened, and you're not getting it back. So that's you can go through. There's tons of other countries you go look at this at. You'll probably see the same curve.
Yep. I think people won't fully bake in until it's at the dollar level. This is just conjecturing, speculating here, but it won't fully settle in with people's minds. I mean, they know the dollar is buying them less, but once this process hits the single digit unit, and that one is given away in terms of purchasing power.
I agree. Yep, the token value is too small right now for people to care.
Yeah, we're at the fractional. You're
Yeah.
breaking up the main unit, tenths and hundredths. You still have those to go, but once it hits the unit of account, then I think you've really crossed the Rubicon. All right, now I wanted to make this in a historical standpoint on where this goes. Obviously, I like to put things bigger picture context, but what you see, we talked about the gold coinage, seigniorage, mints, all of that. This is kind of the process you see, ebbs and flows of society. These pennies now, they're not being produced anymore. They're going to go into the secondary market only. As Dave was talking about, will they be hoarded? That remains to be seen. If this metal content, it's just a bunch of zinc, and then you got to put some energy in to separate out the metals, purify them, etc., to get them into something economically useful. But over the long run, this is what happens, and these things turn into just collector's items as the heaps of humanity just continue to build up on the stacks of history. So this isn't the gold coins there. We can talk about the gold coins maybe later. The U.S. Lady Liberty, Golden Eagles, the Buffaloes, those are still going. We price those differently. Those are still under market demand for the verifiability. But the penny, these things are going through that historical process where eventually they turn into, like, first what happens is you hoard them for industrial cases. The private sector is insanely efficient. I had a friend from our hometown whose business was newspaper and magazine distribution, and part of that process of newspapers, for inventorying them, they would store them on these racks, or there were printing presses involved where you'd have to like hang the sheets, and so there was a washer as a component, something they needed to buy, and the grandfather who built the business realized, I can pay this deal. There was no Home Depot back then, but they can pay their industrial supplier, let's say 2 cents, 3 cents for these washers, which is a key component, or he could just pay some guy to drill holes in pennies at an hourly rate and save a boatload on his input, which was washers. My point here, the private sector is insanely efficient. It actively wants to cause deflation. And so if any industrial process, any finished good that requires these base metals as an input, believe me, someone is looking at the math, at the profit and loss of saying, I can go buy zinc at this market price, or I can go just get a bunch of pennies, pay someone to melt them down. Now, I don't know if this is legal or not, U.S. Mint, whatever, destructive currency, but doesn't matter. It's going to happen. Someone's going to do it, and they'll acquire their zinc that way. So
well,
do these
Matt,
become
yeah,
collector's items?
stealing electric cables from construction sites is also not legal, but it happens all the time.
It happens all the time, yeah. It's stripping of real estate. That's right. So it's going to happen. So that's kind of your first wave, and then, yeah, are these things going to become collector's items? I don't think these pennies, I don't know, we'll see. But on the extreme, if it's something really valuable, here's an example, same site, AppMex. Look at the 1959 to 1982 copper pennies, which were still 95% copper, I think 5% think at that point they got rid of tin, so you didn't have bronze anymore. But these guys, right now, you can go buy a bag for these. It's $50 in face value. For $180 would be what one secondary market dealer shows for price. Granted, who's buying this? Someone, some precious metal collector thinks this is a good store of value. But if you look at that $180 divided by $50 face, that's actually your measure of a measure of inflation in terms of the metal content mark to market against the stamped face value. So about 3x. The latest, let's say this was 1982, but average it out, say it's like 1960, 1970, 40, 50 years, 3x plus debasement. There's kind of your metric of the run rate that the monetary premium, the credit money is debasing against the precious metals standard, which is really, that peg is really a proof of work standard that existed, that the best solution that existed before the semiconductor arrival, before networking equipment, the internet and cryptography, and the culmination of the intersection of all those enabling technologies, in my humble opinion, is Bitcoin, and that is the proof of work money. But essentially, what you're seeing here is the precious metal standard just completely ceding the rope to that 100th decimal point and all of those base metals, industrial metals that it represents. Do we have any more slides? I think that. Oh yeah. Here, my promised one I gave you. What does this process look like in the extremes? This is from something I put together for a presentation or a conference I presented at with Cameron in Mexico City last spring. But you see, all right, we just gave up the 100th decimal place. It's like, yeah, no one cares about that. It's the 100th decimal place, right? It's dividing the main unit, $1, into 100 pieces. No one cares about that. What does this start to look like when you start operating left of the decimal point? This is something that Latin American countries are intimately familiar with. If you go talk to someone, Mexico City, Buenos Aires, Rio, etc., they know. They've seen this story play out in the 20th century. And what it looks like in the extreme, the top row, bottom row, these are banknotes. Top is Mexican CN pesos notes, and the bottom is the Des Mil Cruceros and the Cruzados. Effectively, what you see is a rebasing of the paper money overnight, and they don't even change the imagery. Nothing changes. You just get rid of decimals. So you see it struck. All right. The only difference is you remove 3 decimal places on the left, slap a Nuevo pesos on it. Literally, it was called the Nuevo peso, 100 peso banknote. And then on the bottom row, you see the 10,000 cruceros. That becomes 10 cruzados. Same piece of paper, by all means. Just strike some decimals.
Same guy.
Off of it. Same, literally the same guy, same imagery. Probably kept the same templates on the printing press. All they had to do was change like the well, I don't know the terms, but the little stamps, the dies, whatever.
Yeah.
But this is at the extremes what the process looks like. So this is something very dangerous for the sovereign to play with. And I think, as we talked about Doge at the beginning, the point of Doge is not meant to solve this in one fell swoop. The budget deficit discussion, everything coming up, you're going to hear as the debt ceiling starts to come into attention with April, as we get closer to that. And then these peace talks in Ukraine. All of this is going, like, everything is fluid right now. But I guess this reminder here with the penny is be mindful with your savings and where you choose to store your wealth, your nest egg, your hard work, your time and effort that you want to save into the future.
And with that, should we leave it there for the week?
Yeah, that sounds good.
Thanks,
Awesome.
Matt.
Thanks
All
for
right.
listening, everybody.
Yep.
Have a good one.
All right. See you.